More than $2.3 trillion in global assets are now managed using AI-driven allocation frameworks, marking one of the fastest structural shifts in financial decision-making history. Something just changed inside hedge funds and institutional portfolios, because capital allocation authority has quietly moved away from human analysts and into machine-driven systems. This type of transition has only occurred 3 times in the past 50 years, including the rise of electronic trading in the 1990s and algorithmic execution in the early 2000s. First, I will show you how AI systems have moved beyond assisting analysts to directly controlling investment selection. Next, I will break down how hedge funds are restructuring decision hierarchies around machine-driven optimization. And stick with me all the way until the end, because I am going to explain to you how this shift is permanently altering who or what controls the flow of trillions in global capital. Almost nobody is noticing that more than 68% of hedge funds managing over $5 billion now use AI models to generate primary allocation signals, not just secondary analysis. This shift is occurring because AI systems operate under fundamentally different constraints than human analysts. A traditional analyst might evaluate 50 to 100 investment opportunities per quarter, constrained by time, cognitive bandwidth, and data availability. In contrast, modern machine learning systems can evaluate over 40,000 securities, credit instruments, and private market opportunities simultaneously, identifying probabilistic return asymmetries invisible to human perception. This scale advantage transforms capital allocation from a selective process into a continuous optimization problem. Speed compounds this advantage. Human-driven allocation cycles often unfold over weeks or months, requiring time for research, internal review, and approval. AI systems update probabilistic forecasts continuously, incorporating new liquidity data, credit spreads, earnings revisions, and macroeconomic signals in milliseconds. One large multi-strategy hedge fund reported reducing allocation decision latency by over 92% after integrating AI-driven portfolio construction systems, allowing capital repositioning before human-driven competitors could react. Cost structure further accelerates adoption. The average hedge fund spends approximately $750,000 annually per senior analyst, yet AI systems can scale analytical capacity without proportional labor expansion. Once deployed, AI allocation systems can manage incremental billions in capital without increasing headcount. This scalability advantage directly improves operating margins while enhancing allocation responsiveness. Performance persistence reinforces this transition. Quantitative hedge funds using machine learning allocation frameworks delivered average returns exceeding 17.8% during periods of elevated market volatility, compared to approximately 10.6% for discretionary funds relying primarily on human judgment. While performance varies across market cycles, consistency and speed give AI systems structural advantages in dynamic environments. The most important implication is not simply efficiency, it is authority. Capital allocation determines which companies receive funding, which credit risks are avoided, and which markets expand. As of last year, over $480 billion in private market investments were screened and prioritized using AI-driven credit and allocation models, influencing real economic outcomes beyond public markets. This is how structural transitions unfold, not through sudden announcements, but through silent transfers of decision authority. Capital does not wait for consensus. It migrates towards systems that process information faster, scale more efficiently, and operate without human limitation. And increasingly, those systems are no longer human.